Good morning. It's Jeffrey Christian of CPM Group. It's 10:30 in the morning here in New York on Friday, the 17th of October. I want to talk about the silver market and some of the developments that have been going on in that market and some of the things that are irrelevant and some of the things that are relevant. First, let's go through the markets. Gold and silver, platinum, and palladium have had a remarkable week, rising very sharply over the last 5 days. They're off sharply today in what looks to CPM Group to be a relatively short-term pullback in the market. From a longer-term perspective, and not really long-term perspective, but from the perspective of the next several weeks and several months and several quarters and several years, we expect gold and silver prices to rise. We think that platinum and palladium have entered perhaps new trading ranges, but it may be a little bit premature on that. We're less bullish on platinum and palladium because of their industrial use and their exposure to the auto industry, which is changing dramatically on a global basis. But on an ultra short-term basis, given the sharp increases in prices, really just in the last week, let alone the last couple months, we're not surprised to see that the prices have come off somewhat. We actually issued trade recommendations along those lines earlier this week, and we reversed them on gold and silver yesterday. Kind of wish we hadn't reversed them. In the meantime, one of the things that's interesting, you've got a combination of fundamental factors and macroeconomic factors that have been driving prices higher. We'll talk a little bit about the fundamentals in the silver market in a little while, but the macroeconomic conditions, concerns and risks that are abroad in the political and economic environment, those remain in place. And it's a very interesting period right now because in the past week and really over the past several weeks, what you've seen is not only risk assets like gold and silver that are used to hedge against those economic and political uncertainties have been rising sharply, but also industrial assets, gold, platinum, palladium, copper, aluminum, the stock market, the bond prices, the dollar have all shown strength. That's indicative of a financial market that sees continuing economic strength, even as the rising gold and silver prices indicate that that same financial market is worried about where we're headed. And you can see that in some of the commentaries. Fed Chairman Jerome Powell was talking about the worsening or weakening economic situation, leading to the potential of further interest rate decreases over the next 18 months or so. And as we've said repeatedly, be careful what you wish for, because when the Fed lowers interest rates, it's because it has significant concerns about the economic health of the United States. And that's what we're seeing. So there are signs of pockets of strength still going on, but it's largely debt-driven. And there are even larger signals, stronger signals of economic problems lying ahead. Now, CPM Group actually this week released its 10-year updated third quarter 10-year projections a few weeks late, 2 weeks late, on our economic outlook as well as our gold and silver supply, demand, and price outlook over the next 10 years. And one of the things that we've done is we have been for several years talking about a severe recession in 2025, 2026. We've seen that recession postponed, at least up until now. We haven't seen third quarter data yet in vast quantities, and we haven't seen obviously fourth quarter data because it hasn't happened. But we are seeing signs of weakening economic activity. But what we've done is we've gone from saying we have been saying a severe recession, 25, 26, into 27 possibly, followed by subpar economic recovery and expansion. And that beyond any recession, we would see the global economy, as well as the U.S. economy and other major economies, not recover back to the same sort of percentage increases that we've seen in post-recession periods from the 1980s through 2020. So we're looking at a longer-term weaker economic outlook and prospects for the world until the political environment changes for the better. And we don't see that on the horizon. Now, what we've done is we've revised our economic outlook so we have a less severe recession in 2026, possibly emerging in the second half of this year. We just don't have the data to show that, to see if that's emerging. But a more shallow, a less severe recession in 2026, but more anemic growth with the possibility of several quarters of negative contractions in the global economy. And part of that reflects the fact that the big, beautiful budget bill has postponed and stretched out its contractionary issues. It has a lot of contractionary things in terms of slashing government spending, slashing funding for non-governmental independent university and research institution research, and slashing capital investments and other things. That has been stretched out in the big, beautiful budget bill from 2025 through 2030, so that a lot of the pain, the economic pain that will be a result of those changes, should those changes actually come into being, will not occur until after the congressional elections in November of 2026. It's a very conscious decision to help Republicans get reelected in the elections in 2026. Don't want to really be throwing people out of work and causing them severe problems before you ask them to vote for you. Afterwards, you can screw them to the wall. It's very cynical, but that's exactly what's happened. And so we have this view that the economic and political environment will remain much more hostile for a much longer period of time. And that's positive for gold and silver. It's probably not so positive for platinum and palladium. In the meantime, we've seen gold prices fall $67 this morning, short-term view. But if you look at it, the gold price was, $3,900, even less than that, $3,800 just about a week ago. So the idea that some portion of the $440 increase in prices over the last 5 days is being given up is not a long-term indication of lower prices. Silver prices are off $2.89 a few minutes ago when we started recording this. That should be 10:26 a.m., not 19:26 a.m. Sorry about the typo. It's down to $50, which it was never at prior to late last week. It only breached $50 on the New York COMEX. It breached $50 earlier last week in London because of the tightness in the London market. But on the COMEX, it only breached $50 late last week, early this week, Monday. And it's back down there, having gotten up to more than $53 an ounce. Our expectation is that both you'll see profit taking in gold and in silver and platinum and palladium. You've seen a lot of short-term momentum investments over the last 5 days and over the last several weeks. New investors who are not traditional gold and silver investors, who are focused primarily on futures, forwards, options, ETFs, pouring into the market. Some of them are coming out of the market now. And that's what you're seeing. But again, prices have come off somewhat, $3. But, we've had a $3 spread several days this week. It's not unusual. You could see the prices come back off even more over the near term. Longer term, we still expect higher prices. Platinum prices also have come off sharply. They're off $121 today, but they're still at $1,631. That is a higher price than you've seen prior to this month, going all the way back to probably 2012, 2013, early 2013. And the platinum market, again, as with palladium, which I'll show you in a second, has seen most of that upward increase stimulated by forwards and future purchases as opposed to physical purchases. It's really an investor move, not necessarily a fundamental move. And palladium prices too, the same thing. Sorry, my computer has been balking at the way I treat it. Palladium prices also off $127 this morning, but at $1,549, the highest level that we've seen since early 2023. Expect it to continue to consolidate. Let's see why this machine doesn't want to move. So again, CPM expects higher gold and silver prices over the next 3 to 6 months, and possibly longer. However, the prices have risen so sharply in recent weeks, especially this week, that there's significant ultra short-term downside that exists for all four metals. And we're seeing that today on a Friday, going into a weekend. People just who have made a lot of money in the last 5 days don't want to keep those long positions into the weekend and into the next week. So that's sort of where we are. After such a sell-off, we expect it to be relatively short-lived and relatively small compared to recent gains, because the political and economic risks that we've seen driving investors into precious metals remain in place and have gotten worse and are growing more concerning day by day. Investors have been primarily in the futures and forward markets as opposed to physicals, and they've stopped paying so much attention to the market conditions, and they're acting more on that momentum and bullish sentiment until the bullish sentiment and momentum disappear, at which point they'll all be bearish. Now, looking at silver in particular, silver prices have risen sharply, especially in London. There's been a wide backwardation in the London market and a very wide New York City to London arbitrage that's opened up. The arbitrage has been so large that it's now profitable to buy in New York, fly the metal to London, and then deposit it and sell. Buy the metal in New York, sell it simultaneously in London, lock in a profit that covers air freighting the metal back to London. And I say back to London because I'll show you a couple charts in a minute. A lot of the silver that's in New York and elsewhere in North America has come from London over the past few years. Just looking at the current last couple weeks, coin dealers around the world say that few investors are buying silver and many of them are selling. There are lines that are showing up at coin dealers, mostly to sell this material. And these are investor-sized products, 1 ounce medallions, 1 ounce coins are being sold. They tend not to get refined. They tend to get recirculated in the coin market because they have a positive premium relative to the spot price. The medallions, the non-official coins, and the small bars, 1 ounce, 10 ounce, 100 ounce bars, investor-sized products, they're selling at a discount to spot. And that metal is being shipped to refiners. And refineries are backed up with refining these small bars and medallions and that have been sold en masse by investors. So there are several refineries, major refineries, that are declining to buy traditional silver scrap or delaying pricing that scrap because they have so much of these investor products to refine to good delivery standards and cast as 1,000-ounce bars that can be delivered against the COMEX or the London market. So refineries are backed up. Coin dealers are net buyers from investors. Investors are net sellers. It's looking like this market has showing signs of at least interim peaking. Meanwhile, as I said, the arbitrage between New York and London has been large enough that dealers have been air freighting silver to London. COMEX inventories have declined 18 million ounces in the past 2 weeks, with a lot of that metal heading to London and heading to Mumbai. In Mumbai, you have a much more physical market that has a need for that physical metal. In London, there is less need for that physical metal, and you haven't heard promoters talking about that. But it's a critical issue to pay attention to because you don't necessarily need physical metal to back up derivatives. Derivatives, by definition, I mean, it's the word, are derivatives. They're derived, their value is derived from physical assets, stocks, bonds, currencies, commodities, but they don't necessarily need physical assets to back them up. In some markets, like equities in the United States, you do. In other markets, like any commodity, you don't. They say the world's running out of silver, but even with that 18 million ounce decline in COMEX inventories, they're about 512 million ounces right now, as of yesterday and the day before. They had topped out at 530 million ounces at the end of September. They're down to about 512. Earlier in this week, they were 520, which was 63% greater than the inventories reported by COMEX at the beginning of this year. A 63% increase in COMEX inventories in a world where the promoters are telling you the world's running out of silver. Now, this metal shifts back and forth, and I'll get to that in a second. But it's very funny because on Monday, one of the biggest promoters of the world is running out of silver nonsense over the past 5 years posted a video with somebody who knew something about the physical silver market, and they were discussing how investor-sized silver has been sold by investors, that refineries, so much has been sold that refineries are backed up. They agreed with everything I was saying earlier, that investors are mostly selling and fewer investors are buying silver at this point. That was on Monday. On Wednesday, they posted a different video with a chartist saying that silver would possibly be $70 or maybe even $100 very soon, just looking at the charts and ignoring the massive sales by the investors, the low investor purchases, and the backup silver at refineries. We've got to love asymmetrical markets. And this is perhaps the most thoughtless chart on silver prices. There are some people who have used this for years. It's nonsensical if you stop to think of it. This is the U.S. housing price silver ratio. Now, does anybody actually believe that the long-term changes and evolution in the U.S. housing market and industry, and the supply of housing and the demand for housing, that those economic trends have anything to do or should somehow or other be related to the supply and demand trends of silver? This goes back to, 1965. In the 1960s, you were at the tail end of the post-war U.S. economic boom, and you had relatively strong housing prices, but you were getting out of the silver as coinage, circulating coinage market. And the silver market was primarily, prior to 1960, the biggest use was the silver use in coinage. You also had silver use in silverware, which kind of went away with the cultural revolutions that we saw sweep through Europe and the United States and the rest of the world in the 60s and 70s. And you saw silver in jewelry do well. And you saw silver in photography growing into the 90s. But the silver supply and demand economics are radically different from the housing economics. And one of the problems that you have right now in the United States and around the world are that the housing economics are broken because the supply of housing is out of sync with the demand for housing, with a lot of people looking for affordable housing, starter homes, or empty nester homes, while the construction companies, which have become larger and more concentrated, focus on the McMansions that have a bigger margin. So you have a skewed housing market with higher prices, and it has nothing to do with silver. Now, if you think that silver prices are going to have to rise because of the housing silver ratio being out of line, go to your community college, take an economics class. And I'm going to make this point again. Physical silver inventories do not need to be large or even present to support derivative trading. No metal, no fear. No reason for promoters and sellers to panic investors by saying, oh my God, the silver, the unallocated silver in London is only 120 million ounces. And the unallocated silver in New York has fallen to 512 million ounces from 530 million ounces. There are derivative markets, not in precious metals. Well, yeah, there are some in precious metals that have no link to physical delivery. And even the ones that have the potential for physical delivery, as in London, as in New York, see that 99+% of their transactions are settled for cash. Not when a force majeure is declared, day in, day out. These are derivative markets. They're not physical delivery markets. Some exchanges in some parts of the world actually don't allow physical delivery against derivatives. So there's a lot of misinformation. Now, on the left here, you have London Silver reported holdings, and there are various issues that you have to pay attention to it. But these were begun. The London bullion market only began reporting these in July of 2016, and there were about 950 million ounces of silver in London depositories that reported to the LBMA in 2016, and a big portion of that was already tied up in ETFs and other allocated metal. During the weak economic period leading up to 2020, you saw those inventories grow. There were a lot of investors who were actually selling their physical metal in 2016 through 2020. And a lot of that metal was backing up in the London market because there were heavy sales of silver from disenchanted investors, and mine production was continuing to grow, and other factors were there. And you got to 1.15, 1.18 billion ounces of silver. It started to fall, and it fell sharply beginning in 2021, right? And it declined most sharply between 2021 and 2022, 2023, plateaued, and then it spiked down again late last year, and it got down to about 730 million ounces, 711 million ounces early this year. And since that time, through September, it got back up to 790. So you did see a decline, and you don't know the data before 2016. We have our estimates that it was much lower back in the 90s, but those are our private estimates because this data was considered secret until the second half of 2016. On the right-hand side, you have COMEX inventories, and these only go back to 2003, but we have the data in our silver yearbook going back to like the early 1970s. And throughout most of that period of time, those COMEX inventories were around 100 million ounces, 150 million ounces. There was a spike up in the early 1990s when investors became net sellers, and you had these deficits of newly refined silver relative to fabrication demand from 1990 through 2005. And those deficits were compensated for by a drawdown of inventories, most of which were inventories held by investors. And investors sold about 1.5 billion ounces of silver in that period, 1990 to 2005, on a net basis. And you saw for a while a spike in COMEX inventories up to more than 200 million ounces, and then it came back down. COMEX inventories have been about 150 million ounces until 2017. About the same time London was starting to report inventory. And you saw a big increase to about 300 million ounces. And then it came down a little bit. And last year and this year, into September, they rose from about 300 million ounces to 530 million ounces. Right? 63% increase in this year alone. Where'd that silver come from? Some of it came from London, right? We had a big arbitrage that flowed. London, New York was at a premium relative to London that allowed people to buy in London late last year, much of last year, into the April of this year. You saw a price differential with silver prices being higher in New York on the COMEX relative to London that allowed people to buy in London, sell in COMEX, and ship the physical metal over. Now you've got some people will call it a reverse arbitrage. You have a arbitrage in which London is significantly higher than New York, partly because all that metal came over here. You know, that decline that you see in 2024 in the London from 850 to 711 million ounces, where'd they go? It came to New York because the arbitrage allowed it. Now, the arbitrage is going the other way, and you have people, a lot of that metal came by ship because it was carried across the Atlantic to Canadian ports, actually, off-boarded, untrucked down into the New York market, as well as other markets throughout North America. We have metal stored in across the United States and Canada that doesn't get reported as COMEX reported inventories because it's outside of the COMEX capture area. The same way that you have silver stored in other parts of England that isn't in the LBMA capture area within London's outer belt. So now you have the reverse. It's musical chairs. The silver flows to New York when New York's price higher, and now it's flowing back to London. And that will allow the London market to return to equilibrium. The high lease rates will disappear. The arbitrage will contract. Some of that metal will go off to India, which has also been taking physical metal from London, and the prices will stabilize. And again, we have record amounts of refined silver in above ground inventories. Most of it is held by investors. The ETFs, you can see at the bottom down there, are about 1 billion ounces now. But there's all that coinage, and these are official coins. This doesn't include the medallions and stuff produced by non-governmental refineries and, quote, mints. Right? And you still have a couple billion ounces in bullion form, including that stuff that is produced into investor-sized products. So there's plenty of metal. It's just not in London or Mumbai right now. London doesn't necessarily need that much physical metal, despite what people will tell you or believe. Mumbai actually does need physical metal. And that's going to keep silver prices high because there is demand for physical silver. It's just not that demand for physical silver is what pushed prices higher over the last 5 days or so. Now, here's a video that I came across. It has nothing to do with precious metals per se. The title was "Why Facts Don't Change Minds, Goose Explains." And it was a cartoon of geese, but it was very good because it really went through all of the things that cause investor or believers in things to believe and not change their beliefs, even when confronted by overwhelming empirical evidence and personal experience. You know, guy goes to a coin shop and he finds that most of the there's a lot of customers there, and they're all selling silver. And he can't believe that that's there because some promoter on the internet's telling him that, you can't find enough silver to meet investor demand. So who are you going to believe? You're going to believe this guy who reinforces your beliefs and allows you to believe that you belong to this community of true believers? Or are you going to say, you know what? I'm watching this, and the reality that I'm experiencing firsthand doesn't jive with what I'm hearing on the internet. And you're seeing this not just with precious metals, you're seeing this across political, economic, and social and financial issues. It's a very interesting thing. It's kind of cute, and it might help people understand how to be more introspective and how to be more intellectually driven and empirically driven in deciding what they think. That's all I have for now. Sorry I went on so long. You can go to our website. You can buy our gold, silver, platinum yearbooks. You can subscribe to our precious metals advisory. You can read about a lot of other things. We post reports, we post videos there. You can read about what else we can do for you. And you can send us a note at info@cpmgroup.com. I'll talk to you next week. In the meantime, take care of yourself, take care of those around you, and see what you can do that'll be good for the world this weekend and beyond Sunday. Take care.